Welcome back to another discussion session of our course Research on Corporate Transparency. This time we have Beyer from Stanford University with us talking about voluntary versus regulated disclosure. Anne is one of the most world-renowned scholars in the area of disclosure theory and earnings management. And also we have to be very thankful because Anne got extremely early for us today, given that she's based on West Coast US. So Anne, thank you for coming. And over to you.
Thank you so much, Joachim. Thanks for having me. It's really exciting. I also just realized there's actually a participant on here that shares my last name. That doesn't happen very often. So hi, Bianca. All right, let me get started. You've already talked about voluntary disclosure last time with Joachim and Alfred. And today we want to sort of focus on accounting standards. And I labeled it here also like information systems. And I'll talk about why I did that in a moment. And then we'll talk a little bit about earnings management. And if you sort of think about those three topics, right, one thing that they have in common, and that I think that's really central for accounting research, is that information is endogenous. Okay? So we don't just think, oh, information is there and that it is. We think about where does it come from, how should we design it, or then how might people sort of like manipulate it. In terms of like voluntary disclosure versus like what we are going to do today, like looking at accounting standards, is like the key thing is really like when do we decide to disclose, right? In voluntary disclosure, we decide basically after we see the signal. So I see something and I'm like, oh, do I want to disclose it? Yes or no, right? That is voluntary disclosure. In standards and also in information systems, and that's why I put those two together, is you choose the rule according to which you're going to disclose before you've seen the signal. And then the assumption is that there's some form of commitment, right? And that you can actually commit using that standard or that information system, and you follow that rule, right? And that is really important, the timing. We can see that if we look at something as simple as like, a costly disclosure setting, like think, Varecchia 83, right? If we do that and we have voluntary disclosure, we get sort of a bit of unraveling from the top, right? Till like it's just too costly for sort of the left tail to disclose. That's involuntary disclosure. If you take the same, really simple setup and we now take it into like sort of an information system accounting standard setting, and we ask ourselves up front, right, what do we want to disclose as firms? We would want to disclose nothing. Right? Because we would save all the disclosure costs, and in those simple models, there are no benefits to disclosure. Right? And therefore, we would commit to disclose nothing. Now, of course, that's simplistic, right? There are benefits to disclosure in most settings, but it just illustrates how important it is to distinguish of the timing of like, when do we disclose and when do we make the decision to disclose? Like, when do we learn the information? And in theoretical models, that's always clear because you always have this timeline model, right? And like you can exactly tell. But I think often in empirical research, it's really important that we, clarify like what the timing is that we think, is happening. Do we disclose for? Is it a commitment story? Because otherwise, like the predictions should be really, really different. Okay? All right. I want to just double click on a few things that Joachim said in his videos, and then we can sort of, I'll talk a little bit about my paper with Kevin, and then we can go to the questions. So what do we want to actually like, know about? Well, ideally, we would like to know about optimal accounting standards in a society. Right? But, that is really, really hard and almost impossible, as Joachim explained in his video. We would have to sort of, it's a welfare question, and we would have to trade off different sort of like constituents' welfare and utility. Okay? So what we're going to do is we're going to like sort of simplify that, right? And then see that we get somewhere where we can actually answer a question. Okay? So probably the next one would be sort of saying, well, let's just focus on markets, right? There we can often like agree on some form of efficiency measure that would like sort of like measure how well we are doing, right? And therefore, it might actually be like something that we can answer without having these policy and welfare questions. But it's still really, really hard, right? Because there's so many transactions, right? And they all look a little bit different. And now how are we going to write one accounting standard for all of them? Right? So maybe, we'll take it, slow, and we'll go to just one firm. Right? And so that's why I now labeled it information system, because this is not a standard for everybody anymore. we just as like a firm or company, we would want to like design our own information system. Again, it's like commitment, right? So I design first, and then later the signal comes and I sort of like produce whatever signal it is according to my rules. But it's still like a complex system. There's still many, many transactions. So let's make it a little bit easier, right? And actually look at just one transaction at one specific setting, right? But with multiple agents. What do we mean by multiple agents? Well, I might be the manager, I disclose something, and then I have some people, like some agents basically react to that, right? So that would be like a question that's now, you can see, quite removed already from optimal accounting standards in society. But if we at least could sort of like understand what's happening in one specific setting with multiple agents, we could still like hopefully learn a little bit about the accounting standards. And then of course, if you wanted to go even simpler than that, right? Then we could think about an optimal information system for just one specific, single agent in one specific setting. And that is like, actually the one that, Joachim also talked about. That's where we have, a really good answer to the very last one, because that's, of course, sort of, if you think about like, Dembski's setting, right? What does it say? It's the impossibility of normative accounting standards. But on the positive side, you could sort of say, the one thing that we can say is that finer information systems are preferred in single agent settings. Okay? So, and it's really important. The only thing we can say is that it's finer, right? Not if it's just different, it has to be finer, and it's a single agent setting, right? So just like here's an example, right? Two information systems. The red one is like low, high, right? And the blue one is like low, medium, high. And now the question is like, which one is finer? Okay? And the answer is, of course, neither, right? They are not finer. We can't rank them. Right? They are different. Mm-hmm. Why would it ever be that we prefer the red one to the blue one, even though the blue one gives us like 3 segments, right? And therefore, like if you think about like ex post variance of beliefs or uncertainty, it's probably going to do better. But why might we still sometimes need the red one? And therefore, we cannot compare those two settings, right? Those two systems. Well. Just a really simple example, let's say, this is sort of the NPV, the possible NPVs of like projects, right? And the question is, should I pursue this investment? Right? And let's say the red one tells us like basically, at 0, and then you can just, right? 0 is the NPV rule. So, above that we invest, below that we don't invest, right? That's all we need to know in some sense for like NPV projects. And then if we decide whether to implement them or not. Now, if the blue one gives us something like that, right? Where it's like, up to -10 to 10 and then like above. Well, we know what to do in the tails, but in the middle we don't know because we don't know whether it's like, above or below 0. And so you can see, right, that here we cannot rank those systems because we can, of course, also make up other decision problems where the blue one would be preferred to the red. And so these are two that we cannot rank. So this is not finer, right? And I think, again, sort of in theory research, we sort of see that relatively easily. I think, in empirical research, it's often not that clear to say, is something really finer, or do we just have sort of like more signals coming out? Yeah? So what would be an information system that's really finer, right? Then like either of the two, that would be the one at the bottom, the gray one, that's now finer than both the red and the blue. Okay. So that's what we know about sort of optimal information systems in a single agent setting, right? And that's really something that we can answer, that Dembski answered for us, like, in 1973, so 45 years ago or something like that. All right, so given that we know pretty much, a lot about that one, let's move one up and make it a little bit more difficult, right? And so let's look at the optimal information systems for one specific setting, but now with multiple agents. And then just want to double click again on like the nice paper by Goetz and Wagenhofer, right, that Joachim also already presented to you in his videos. Right? So, and this is a really simplified version. So, Alfred, I know whether you're on, or Robert, I hope, he won't hold that against me. So we have a bank loan with a collateral, right, to finance a positive NPV project. Okay? And here we have different values of the collateral, but given that it's always a positive NPV project, right, the first best investment is that we would like, to invest for any value of collateral, right? Because the NPV is always positive. The collateral, in some sense, is like totally removed from that. This is just like something that the bank would like, so that it's like, can sort of protect its downside risk. And so if we think about that, right, let's say, the bank requires sort of a minimum expected collateral, right? If we like tell the bank nothing, right? So this is like supposed to be the information set here, like this gray oval, if you want, right? Depending on what the distribution looks like, of course, and stuff, but we would, if there's enough weight in the left tail, then the bank would not disclose, would not invest at all, right? If we like give the bank much finer information, where basically we identify every single like collateral value, right? Well, then, the bank will lend, but of course, only to the ones that have higher than the required collateral. And so now the question that is answered in the paper is like, how can we sort of increase that investment efficiency? Because the first best investment is that everybody invests, right? So now we want to like increase at least, those number of green points so that we get a little bit better in terms of investment efficiency, right? And that's where sort of this idea comes in that, well, let's just pool the people at the top, right? So if we, for example, only pool those, right, the bank would still, of course, lend the money because they know all of them are higher than the expected value of the minimum required collateral, right? But we can actually throw more people in that pool, and still, as long as sort of the average is still higher than this minimum expected collateral by the bank, right, the bank will still lend. And now we increase the set of of firms that the bank will lend to, right? And that helps basically with the investment efficiency. And so here you can see, right, that like in multi-agent setting, finer information is not necessarily preferred, because the finest information that we had in the beginning was that every sort of collateral gets its own circle, right, its own signal, but that would not have resulted in the same kind of investment efficiency as like the bank, as we have here, where we pool the right hand. And so that's in some sense the idea, right? And then we can sort of say, well, that looks a little bit like lower of cost of market, right? It does in the sense that there are sort of at the right tail, there are these people that are pooled. At the bottom, they are like more precise signals, if you want, right? It doesn't say, though, where sort of the cutoff is between green and red here, right? It's not necessarily at historical cost, right? And so that's what I meant in the beginning when I said, like, for specific settings, right, we only can sort of say something about specific settings because the cutoff of like how we would want to pool it, how we would optimally like to design the information system is very situation specific. It depends on like the size of the loan, the agency problems, all of these kinds of things, the distribution of expected cash flows. And but it gives us an idea, an example of like, why do we not just want to like disclose as much as possible? Now, just one remark here that I like about this paper is like, if you look at this information system, where we now pool not just the ones at the top, but also the ones at the bottom, right? That leads to the same investment behavior, because the bank will still lend to the ones that like just give you the high signal, right? And whatever the other ones say, it doesn't matter as long as they say something different so that we know who to lend to. And if you think about that, that doesn't actually look as much as lower of cost of market, right? To me, that always looked a bit like sort of qualitative disclosure, if you want. Right? So I know that is not the interpretation that Robert and Alfred are pushing in the paper, but to me, that's actually, it's another takeaway from this paper, that there's a good role for qualitative information if we look at it this way. All right, so this is basically where we are, right? So most of the papers that we see on optimal accounting standards is really sort of about optimal, if you want, information systems for one specific setting with multiple agents. That's where most of the work is these days, right? And then, sort of, you also see a little bit on sort of optimal accounting standards in markets, where they basically look sort of at information spillover. For example, bank runs in the context of like disclosures for banks, that kind of stuff. All right, so much about like the accounting standards information systems. Now a few words about like my paper with Kevin. So it has a pretty long title. So learning about risk factor exposures from earnings, implications for asset pricing and manipulation. The good thing is it's sort of a short summary of the paper of what we do. right? So we learn about risk factors and then think about what does it mean for prices, for the relationship between prices and earnings, right? And for earnings manipulation. So if you think about like, very simple like pricing, right? You could say it's sort of like expected cash flows, and then you like somehow discount that reflects like the systematic risk, right? And what we've done a lot in accounting research, right, is we have thought about like how do investors use reported earnings or many other signals, of course, right, to learn about expected cash flows, right? So we try to forecast future performance. We try to forecast just future earnings, but also like future cash flows, future investment behavior, all kinds of things, right? And it all sort of goes to sort of this expected cash flow in the top, right? And what we add here is that we have the investors learn about both things, the expected cash flow and the systematic risk, both on reported earnings. So what's the setup? I'm going to do that fairly quickly, right? So we have sort of a factor structure of earnings. So 2 periods, earnings in the first period, some idiosyncratic component A here, plus B, and that's firm specific times some factor that's like basically in our case just the aggregate earnings over the entire economy, right? And the same then in the second period. And the key thing here is that the factor exposure remains the same across the 2 periods. Right? So if we learn something about in the first period about the factor exposure in the first period, we can like make inferences about the second period. The same is true for like the idiosyncratic or something similar is true for the idiosyncratic components. So they are somehow correlated across time, right? So if I learn something about A1 here, I can infer something about A2. We could have added some noise to like so that the B sort of changes from period to period. It complicates the math quite a lot. It doesn't affect the qualitative results as far as we can tell. Investors are risk averse, well diversified, right? So it's a large economy kind of paper. And as I said, like, investors learn about expected future performance, basically about the future expected earnings, as well as sort of a systematic risk factor. We have the nicest setup you can possibly sort of think of, right? Normal distributions, car utility functions. And so then with that, we obtain a factor structure of price, right? That should sort of look fairly familiar. So it's like essentially the expected value of idiosyncratic earnings, both in this period and the future, then plus like beta times an expected return on the market portfolio. That works out sort of like so nicely is in some sense a bit surprising. At least it was to me in the beginning, because if you look here, right, at the top in the earnings structure, we have multiplied 2 normal variables, right? We multiply the B, which is normally distributed because there's uncertainty about your risk factor exposure, right? We don't know exactly what firm systematic risk is. And then there is like the factor itself, which is also normally distributed. Right? And usually like, multiplying 2 normal distributions and then want to like do a car utility function over that is not pretty, right? And that's the same is true here. The only thing that sort of like saves us is that the non-normal part is idiosyncratic and therefore it diversifies away, right? And so that's why, in the end, it still all comes down to like the very sort of nice and, setting that we are sort of used to, right? Expectations are linear, right? In normal distribution, so that like helps us a lot, right? And so for a given market performance, a firm's price is linear in its earnings in our equilibrium as a result. Okay? And that's, again, it's the same as like, in other Kara models where we don't have this market performance and it's just unconditional, right? Here we have to condition on the market performance, then our prices are linear in earnings. And as a result, the idea of like an earnings response coefficient is well defined, right? Because it's a linear function, so it's just the slope. Okay. What are the predictions? Well, we have to, because it's conditional on the market performance, we have to distinguish here between economic downturns and economic upswings, right? And in economic downturn, right, on both economic downturn and economic upswing, higher earnings always indicate, right, that the performance is higher. Both the current performance and the expected future performance is higher, right? And as a result, the stock price should sort of increase. It's just earnings are like a positive measure in some sense, right? Now, if we look at the economic downturn and now think about risk, right? Well, higher earnings actually indicate lower systematic risk. right? Because it's an economic downturn, meaning that, the economy is poorly. If you now get like slightly higher earnings, right, you're sort of showing that you're actually like less correlated with the market, meaning that you have lower systematic risk. Right? And lower systematic risk is like something that the market likes. As a result, the stock price would increase again, right? So these are sort of the two factors that happen, of course, at the same time, and they go both in the same direction, right? In contrast, if you look at the economic upswing, if we have here higher earnings, right, given that the economy is also doing well, that actually like indicates that we have higher systematic risk, right? Because you're now more correlated. And that's like, higher systematic risk means that you have like a higher discount, and therefore the stock price actually decreases due to that factor. So overall, in the economic downturn, it means that the stock price sort of increased a lot, right? Because both of those factors go in the push the stock price up and go in the same direction, while that effect is dampened in an economic upswing. There, those two effects go basically against each other, and so the positive reaction to earnings is just like sort of like muted, if you want. And that gives us like our key prediction here that the ERGs in economic downturns are higher than those in upswings. So what does it look like? Well, so here we have it, right? So one is like for us just a standardized one. If we like knew what systematic risk was, then we would just get an earnings response coefficient of 1. In economic downturns, so that's here the left tail, that we get higher ERGs, so the ones above 1. And then in economic upswings, we get ones below 1. But you can also see, right, that it's actually not monotone. Right? And so why is that? Well, again, like, the flat line of 1 is like basically what the reaction would be if we knew what the systematic risk exposure is. So in a normal model where we didn't have this additional factor where we learn about systematic risk, in our model, given the simple setup, we would just get this constant earnings response coefficient of 1. And if you think about the tails, right, given that the market performance is so extreme, I can really see how correlated a firm is with the market performance, right? As a result, you basically almost know everything about the beta that there is to know, right? Or the B here in terms of earnings factor exposure. And as a result, moving earnings a little bit doesn't actually change your beliefs about the factor exposure, right? And so you're again close to the one where you act as if you know everything about your factor exposure. Right? And at 0, it's a bit different, but there's simply like you can't learn anything about your B, right? If you multiply it by 0, because everybody's affected in the same way, and so you can't actually infer anything. And again, you react as if basically the factor exposure was known. Right? So that sort of explains our shape. And now, to the earnings manipulation, which is sort of the key here. Well, earnings. So whenever we change the earnings response coefficients, and we believe, right, that that managers are somehow they care about prices, right? Then the higher our earnings response coefficient, the higher the incentives to manipulate. Right? Because like if you like just manage to like increase your earnings by an additional cent or so, you just get more out of it, right? If the earnings response coefficient is higher. And so in economic downturns, as a result, in our setting, you have therefore stronger incentives to manipulate, right, than in economic upswings. And given that earnings manipulation, we assume that to be costly, right? So think about real earnings management, could be some gains trading or something like that, right? Then you have like greater costs of earnings manipulation, right, in economic downturns, and lower costs of earnings manipulation economic upswings. And so if you think about that, in economic downturns where things are already pretty bad, right, now you're like having even greater costs to do this earnings manipulation, which lowers the firm values even more, right? While in good economic sort of situations, it lowers the firm value, but just not as much, right? And as a result, the difference between the outcomes in the economic upswings and the economic downturns is now larger, right? And so that means that the systematic risk actually increases in our setting. So there's just like one, application of like thinking about earnings manipulation. What do managers do when they have different incentives to manipulate, meaning when here the earnings response coefficients are different. All right, that's all I had. I'm already above my time anyhow. So why don't we go to the questions? Does it sound good?
Wow, Anne, thank you. That was really impressive. You know, when I was going through the paper, I thought, well, this is not easy, but the way you presented it was just super crisp. So thank you for that, and also, of course, for the introductory remarks. I think they were also spot on and extremely helpful. Now, without much ado, I think we should dive right into the questions. And I think we're going to start with a question by, the way that I want to organize this, like every week, we're going to focus first on the paper that you presented a little bit, although the questions are mostly about extensions. So what if kind of questions related to your paper. And I know that theory people love these questions. But anyhow, it's always tempting to ask. And then we will move on a little bit to, let's say, some more general questions, and towards the end we will move into the metasphere. Yeah. So, but let's start with the question from Lazarus. Lazarus, can you just please unmute yourself and ask your question?
Yes. First, thank you very much for the great presentation. My question is kind of a behavioral one, but I'm neither an expert, neither in behavioral finance or accounting, nor in financial accounting, so I hope you will not hunt me out of the room for it. So first, when I saw the results of the paper, the first thing that I thought was my basically behavioral finance 101 class, Kahneman loss aversion, where they basically stated that people fear losses more than winnings. And when I saw the results, I thought, okay, would that be a possible explanation of why the earnings response coefficient is higher in economic downturns, because they expect a loss, and then maybe the same change causes a difference or a higher response to a positive signal?
Yeah. So, we share something that I'm also not an expert in behavioral stuff, but so, take that with a word of caution here. I mean, the first question, does sort of this behavioral aspect of like loss aversion affect stock prices? Given all the experimental evidence in particular that I'm aware of, right, I would say yes, right? I mean, like people do seem to like be very loss averse, and you would expect that to reflect in stock prices, assuming, right, that like people that show this kind of trait are the marginal investors, right? Given like the large number of institutional investors that we have out there, I can't really say, but even like fund managers are probably like loss averse. So let's take that sort of as a given. Is that similar to what we find in our paper? I think that's a bit more nuanced, right? Because if you sort of think about it, our earnings response coefficient is a constant, right? Meaning the price earnings relation is actually linear. So on an individual asset level, we certainly do not show loss aversion. Our result is not, looks anywhere similar to loss aversion. So then we would have to go basically into, and let me actually stop sharing my screen here. I see that just now. Did that stop? Yeah, okay. If we then think about it in any form, we would have to think about it sort of in a portfolio setting, right? As you said, if the market overall is doing poorly, maybe then we react stronger, but now to individual signals, right? And so I think that's like quite removed, because usually we think about loss aversion about like you react stronger to negative signals, not you react stronger if your environment is more poorly in some sense, right? So I think it's a bit different, but I can see where you're coming from, right? And maybe like someone who's like an expert in behavioral research could make a link that I just can't. Okay.
Thank you very much.
Well, thank you from my side as well. So the next question is also related to some of the assumptions of your paper, and it's going to be asked by Rusha Nandi. Rusha, please.
Hi, Anne. I thank you for your presentation. I absolutely loved it. So my question is about one of the assumptions in your JE 2021 paper. So one of the principal assumptions that you have in your paper is that investors are not perfectly informed about the firm's exposure to systematic risk factors. Mm-hmm. But one of the point is that like the degree of information that investors have about this firm's exposure to systematic risk often depends on the level of voluntary disclosures made by the firm. So do you think that the level of voluntary disclosures made by the firm could affect your model in some way?
Yes, I mean, we don't model it, so, where would we see it in the model, right? And if we don't want to change the model and we want to interpret the model in some way, related to what you said, we would think about like the prior beliefs, right? So if, it's in fact true that voluntary disclosure, changes investors' beliefs and gives them more information about the risk factor exposure, we would think that we see that in the prior beliefs, right? And that those just become tighter because we already know more, right? So that's how that would sort of like directly flow into the model. But, of course, all that you know about like voluntary disclosure is that it's selective, right? Meaning that we probably wouldn't get like, a signal that would preserve normal distributions or anything like that. So in that sense, I'm reluctant to say, you can map that one-to-one, but that's where it would basically show, but we still would have to somehow impose, that the posterior beliefs and after observing the voluntary disclosure is normal. And from anybody who has done voluntary disclosure models, that is generally not the case. So,
Thank you. Thank you for that.
Rusha, when I was reading your question, I was thinking about this question as an empiricist, and maybe just one quick remark in that regard. So I found it interesting to think about what would be the type of firms that actually would have an incentive to disclose, let's say, their risk factor or the impact of the risk factor. So what kind of firm would have an incentive to disclose that? And this is just an empirical ad hoc thing. But I could imagine that this should vary with the extension of which a firm is interested actually to be traded by, index type of investors. So because we know that firms that really want to trade with the market, that they have an incentive so that the market really understands their risk factors really well. Whereas there are other firms that maybe have less of an incentive of doing so. This is more or less completely orthogonal to the model discussion that Anna has. But I think this is also interesting to think about it, because I haven't seen that many papers that actually look into the question, which firms have a direct benefit from having a very transparent risk structure and which firms don't, right? So I think this would be, from a just exploratory standpoint, almost also interesting to think about. So I really like that. I like that angle. So next up would be Carol Waltz. You have two questions that you want to ask. And first, I think the question about the reversal of earnings management would be perfect.
Yeah. Hi. Also thank you for your presentation. I really liked it. I was just wondering about when the manager chooses the bias in terms of earnings management. I was just wondering, like Professor Gassen mentioned in his video, that we have this reverting effect mostly when it comes to earnings management and future periods. So I was just wondering how this would be included then in the manager deciding on the bias.
Mm-hmm. So frankly, when we put that in there, we didn't have anything in mind necessarily with the reversal, right? So we were thinking more like, as I said earlier, let's say gains trading or something like that, right? Where you sell assets today that might have been better to hold on in the future, because they give you more benefits, but because they're trading at a gain, you do that today, then, it pushes up your earnings. There's lots of empirical evidence for that kind of behavior. So first, I think, not all earnings management actions need to reverse in the future, right? But, certainly some do, right? Now, when we think about reversals, what we mostly think about, right, is sort of accrual earnings management, right? I overstate earnings today by, underestimating the provision for bad debt or something like that, right? And then, of course, that doesn't actually change how many customers pay me. So in the future, I'll have to reverse that because, I just won't collect. And that by itself is not going to work in our model, right? And the reason is that it doesn't have any cash flow effect, right? And we need to have sort of real earnings management in some sense where it really destroys cash flows from the firm's perspective, right? Otherwise, it just doesn't work here.
Okay, thanks.
So, yeah, it's a bit of a different setting. It's not the typical accrual earnings management setting where you would have a reversal in the future. Generally, when we model that kind of stuff, and then we have multiple periods, because as you said, it needs to reverse. My recommendation would always be model it on a balance sheet basis, right? It's much, much easier to keep track than like model when it reverses. Because when you do sort of the direct reversal, you have to make assumptions of like, when is it going to reverse? Next period? 2 periods from now, right? It all depends on what exactly you have in mind. And so when you model it based on a balance sheet basis, where we just look at the cumulative amount, these things can be sort of sidestepped. But that's not, what we have in the paper.
Thanks a lot. So the next question is going to be asked by Mirab Sohail. I hope that I don't mispronounce her name, Mirab. Sorry.
Hi, no, you pronounce it correctly. And thank you for your presentation. My question is that you say in the paper that in the economic downturn, the real earnings management rises, which contributes to the systematic risk. And you say that all firms manage earnings. So is it an assumption? Because in real life, firms, they are a small part of an economy, unless you're talking about a monopoly or some key player in the industry.
Yeah. So paper doesn't need that all firms manage earnings. As long as it's a positive measure of firms in the economy, that's enough, right? We just can't have it so few that you can fully diversify it away, because then there's nothing, it wouldn't affect sort of the systematic risk. But as long as it's a positive measure of firms in the economy, that's enough for our model. We didn't put that in there because we didn't think it provided sort of like additional, useful comparative statics or so that we could do. But you can imagine what happens, right? So the fewer basically, are in there, as long as it's still a positive measure, the less systematic risk is added, because they're just like a smaller part of the economy.
Okay, thank you.
A quick follow-up clarification question, if I may. So that means that the share of firms that will manage earnings mostly depends on the cost structure that you, or cost-benefit structure that you impose, and the variance of this. Or what drives the decision?
No, in our model, like everybody, because we have the same cost structure for everybody,
Okay.
they all manipulate. But we could have put in like something where, it's so that not everybody will manipulate.
No.
Maybe some are pathologically honest, or, the cost structure doesn't work out. And it would have still worked as long as it's like enough, as long as it's still a positive measure of firms that like manipulate.
Got it. Thank you. So, Caro, you're bringing up Texas now. So Texas.
Yeah, so I was just wondering, like, how in your model, like, for example, if you introduce taxes, how that would change, how that could change also the relationship, for example, between earnings and expected returns, because taxes also like have effects on cash flows and stuff, and so I was just wondering, how this would or could be included, and then also whether there could be then also country-specific differences.
Yeah. I think I have to go and get my colleague Becky Lester for that one. No. Okay. So, of course, as you said, like taxes affect cash flows, right? And as a result, they affect lots of things. Right? Now, if we're like sticking a bit more to the model, then we would have to say like, car utility functions are independent of wealth. So to the extent that the taxes are not related to the income this period, but to wealth overall, then it wouldn't have an effect in the model, right? Now, more broadly, like, what would my gut feeling say, in practice, what will sort of show up in stock returns? I guess it depends what kind of taxes you sort of have in mind, right? California, given that we're now sort of more left-leaning overall again, right? So thinking about like a wealth tax here, it's like 0.4%. I think if you have like more than a net worth of like 20 million or something like that dollars. So that's not a lot of people, right? That sort of fall into that category. Now, those people, of course, have like a large proportion of the assets. But my gut feeling would be that it doesn't affect it. But of course, it depends on like, there are many other taxes that you could impose. And so I would have to really think through that carefully. But in the car utility function, you're protected from these kinds of effects quite a bit, as long as it's not like sort of a pure income tax effect.
Thank you.
Wonderful. And then we have, and this is the last question related to your paper, then we move on to some more general questions. A question by Lisa Lübke. Lisa, please.
Yeah, hi, Professor Beyer. Thank you for the presentation. And I have a question regarding the use of earnings in order to derive the current and future risk exposures, because what I've learned in classes so far is that the income statement represents revenues and expenses for the current period. And this is why I thought there are not really developments or future developments included. And even if you think about the fact that annual reports always get disclosed later than they're actually reported on, I have the question, like, where does the future component come from? And if maybe you could also like include future
future like earnings forecast.
Exactly. Yeah.
So the link to the future does not come from accounting, because as you said, exactly right. Like most of the accounting is backward looking. Now we could do fair value accounting that's like more forward looking, but most of the, you could argue it's like more sort of on the past. Right? The link to the future comes from the real economics, right? So basically, let's leave the business part aside, right? Let's say, you have a race, among like sprinters, right? And you want to predict who's winning. Well, you will look at the past performances, right? You will see like how fast were they running in the past. And then you're like, okay, it's not exactly what they're going to do today in my race, but it's probably predictable, right? There will be a link, right? And that's the same what we do with firms, right? So we look at the past performance, knowing that is in the past, but because the underlying economics, the factory, the intellectual property, the people, and all of that, it's like relatively constant. We say, okay, even if it's this in the past, we can learn something about the future, right? And so that's basically what's going on here. We learn about past earnings, and we can learn, we observe past earnings, if you want, right? Let's take away the earnings management. So we observe past earnings, and we say we can learn something about the future because there is this positive correlation across time, right? So that like whatever happened in the past is predictive of the future. And there is quite a bit of evidence, right, in the empirical literature on that past earnings predict future earnings. Often like going back, like, they do time series estimates, like, 10 years, sometimes even 20 years going back, by using that to like predict future earnings. So there is definitely this time series effect. So I think, in that sense, we are good there. But it's not a one-to-one mapping, right? It's like the sprinters. You don't know exactly what they're going to do today in the race, but you can sort of like make a prediction based on their past performances.
All right, thank you.
Okay, so now we're going to move on, as I said, to the somewhat more general questions. So we're moving away a little bit from the paper. And the first two questions will be asked by Ariana Pichella. Ariana, please.
Thank you. Thanks a lot. And thank you, Professor Beyer, for your explanation and presentation. So yes, I have two general questions because I'm interested in the particular involuntary disclosure. And I was wondering, I was curious to know your opinion about the social media disclosure. If we can consider disclosure that company do voluntary on social media platforms as a form actually of voluntary disclosure, and how powerful it is, because we have seen that investors seems to react very quickly after social media sentence and post, even if it's not regulated and if it's voluntary disclosure. So I want to know your opinion on this. And the second, can I ask the second question? Or? Okay. The second one is more about the actual user of the financial and annual reports, because I was wondering, these are very long reports that maybe are not actually read by investors, but are food for machine learning and artificial intelligence. And I was wondering how especially regulators should take these into account if in designing new standards, taking into consideration the actual reader of these reports. Okay,
so I'll give this a shot, but my first part of the answer to your questions, and to both of them actually, is like ask Beth Blankenpour. So my former colleague, is she the next one, or I saw her in the lineup. So she really knows that stuff. Okay, so she has done research on social media. And she has done actually now the most recent JEE survey on disclosure cost, information processing costs, which goes exactly, I think, to like your second question in terms of like, if you have so much information, who actually benefits from that, given that, maybe for individual investors, the information processing cost is just too high, right? If you don't have like these AI technologies and that kind of stuff. So that's my, my real answer is like ask Beth. But I can still sort of give it, a brief shot here. I mean, of course, social media and stuff, it matters, right? It's a signal, right? And investors react to signals. Now, if you want to compare it to like, financial reports, I don't think it has, like overall, not taking out just individual observations, but like, on average, as much of an impact, as like financial statements in some sense have. But it has, it is predictive, right? In some sense, it's very much like, people that took pictures like from parking lots and counted the cars in order to like predict revenues, right? Those cars in the parking lot, they're predictive of like, future performance, and therefore investors react to that information, right? And of course, in social media, it's much more widely accessible, right? It's like, I mean, I didn't go to a parking lot and take pictures, right? Or like count the cars. So, it's something that like many more investors can react to. And so, I would think, there is a strong reaction. It really matters. But in terms of like reliability, in terms of, I think you mentioned trust or something like that, it's hard for me to imagine that would really dominate. But maybe I'm like tainted by like the trust issues we have around social media around here. But yeah, so I don't think, that it's like, it reaches over the same level, but it's definitely predictive, right? Because it's a signal.
Yeah, thanks a lot.
Sure.
Okay, so we have a follow-up question that is also relatively closely related because it deals with the effects of earnings announcement on Twitter. And Rebecca, I'm not sure whether you want me to ask the question or you want to ask the question. Can you just unmute yourself and ask if you want?
Sure, I can ask a question. So first of all, thank you for your presentation. It was really good. And my question relates to earnings announcement on Twitter and actually the effect that we have on transparency. So it would be more like, how does earnings announcement on Twitter affect transparency? Does it improve transparency, or do we find ourselves in a place where more information wouldn't be desirable? Could we say that this type of strategic disclosures would create more types of information asymmetries? And if so, how could it be regulated?
Yeah. I mean, so again, like, we should definitely ask Beth again, but yeah, of course, it's another distribution channel. So if it's earnings announcements, right, that are distributed there. So I would say that probably like, makes it more accessible if it's not additional information, but like, just sort of a different channel where the information is distributed. So there I would say probably it would reduce information processing costs, but there might be some arguments that sort of speak against that. I mean, generally, this is the really hard part, right? And we saw that sort of the debate, I think, if you want to sort of look at formal literature and like get a sense of like, what has been done in that area, I would look at the pro forma disclosures, that we have around earnings, and where the SEC got really, concerned about that, like firms disclose these pro forma earnings in addition, right, to the regulated earnings, so to GAAP earnings, right? And so you could again argue, right? Well, it's additional information, so how could anybody be worse off, right? But then it's exactly sort of what you're saying, right? Well, what if we sort of care a lot about individual investors, and maybe they don't have the same understanding, right? And therefore might be more misled by pro forma earnings, because when you look at pro forma earnings, you know that they mostly exclude expenses. They don't exclude all that many like revenues or gains, right? So like, they might be more misled, and maybe we want to protect, individual investors from that. And then of course, also like what you said about information processing costs, and like, it's an additional signal, who can process that and who has sort of like the time to do that. And so maybe you want to actually limit, in that sense, like the disclosures that firms make. Can it be regulated? free speech is pretty powerful, but the SEC is as well. So, if they want to, they probably could. I don't see it coming, but yeah.
Thank you.
Good. So now I'm supposed to ask a question on behalf of Dennis Katze. Dennis, if you're around and you want to ask the question yourself, feel free to unmute me, to unmute you and mute me. So this is what I wanted to say. So Dennis asks, well, there is evidence that increased level of transparency or disclosure reduce welfare. However, it is often claimed that more transparency is needed. Concerning which stakeholders do you think more research and insights are needed with respect to costs and benefits of mandatory disclosure? And if I could add to this, I would be interested to do whether you agree with the first part of the statement, that there is convincing evidence that increased level of transparency reduce welfare. So empirical evidence, that is.
So, maybe let me first answer the second question. All of them. I think we really don't know much about that, right? Yeah. So in terms of like the first one, is there strong empirical evidence? There's sort of the evidence around bank runs, right? That is pretty convincing, both on the theory side and the empirical side. So that would be like one thing where I would look. The other one is in the IPR area, right? There is like evidence on like, how basic, at least in the US, sort of the patent law sort of changed when certain things, when you file it, actually becomes sort of like known to others, right? And one of my colleagues here as well has like done some research on that, and it affects people or like firms' R&D spending, right? And so if that is true, that it affects firms' R&D spending, meaning that it takes away incentives to like innovate, right? I would say that this, it's not conclusive evidence that is like welfare reducing, but it's something that would concern me, right? And so, so I think these are sort of the areas where I would look in the empirical literature, and I think there's definitely evidence that it reduces welfare. The question is, does it reduce welfare on balance, right? That is the hard one.
Yeah.
So, and I don't think anybody can tell, because we can't even agree on what about, a welfare measure, essentially, right? But yeah, I think, you can find evidence on like that it reduces, certain things that we think are related to welfare, but whether on balance it reduces welfare, I think that is a really, really hard question.
Yeah, but I think it's also very important to see the different, let's say, channels or mechanisms through which actually this negative effects of transparency can manifest. And then in the end, maybe it's almost a political judgment question, right? So where in the end we believe that in total the balance should be one or the other. Very interesting stuff. So now we have a question that I think came up relatively shortly before your talk. It's related to incomplete contracts, and I think once you're around, you can ask the question, right?
Yes, thank you. Good morning. Also for me, my name is Ulrich Katz. I'm at NYU, and I'm working on a project with my PhD coordinator, Ilan Gutman, which I think was at Stanford as well. And yeah.
You should go ask Ilan about that, but yeah, no.
Well, so, we're working with disclosure, and your review is very extensive, and I refer to it a lot, but it occurred to me that there's sort of no specific reference to incomplete contract theory or sort of accounting information, how it's used in private debt contracting or covenants. And I was wondering, is this because it's subsumed or it came later, or, what's your sort of 10-year review of the review?
In the end, it's sort of like what we were tasked with by the editors. So it's above my pay grade, So yeah, is your question like whether incomplete contracts matter, or like how they, maybe can you rephrase your question?
Yeah, I guess my question is whether this was a topic that came up to prominence only recently, and so maybe at the time it wasn't so important to mention it, or maybe it's just part of something bigger, so it's like just subsumed.
No, it's not something that only came up recently. It's true, certainly, that sort of certain topics, they, come in and out of fashion, right? And sometimes they're like more fashionable and get more attention, and then sometimes it's less so. I don't actually know what it was like, so much 12 years ago, so many worked on that, but No, it's not something that came up only recently, right? But it wasn't the focus of our survey. I'm not just trying to think about like, I mean, it was like this whole conference of surveys, right? And there were like quite a few other surveys in there as well. I'm wondering whether any of them would have like done that.
Well,
Yeah,
maybe
there
I
was
could.
kind of corporate governance that probably would have thought about like incomplete contract. So that's probably where I would look next.
So maybe I can rephrase it and say, like, if you were to issue a similar review today, would there be anything that's like new or like you would really want to include that at the time wasn't so at the forefront of the thinking?
I mean, yeah, you know, in terms of like, especially on the back end, you know, the information intermediaries, we were very much focused on financial analysts. And I think that is a bit outdated by now. So I think we would certainly like want to broaden that definition. I think the whole question around standards that are different from financial standards, right, is something that, you know, like mandatory disclosures around like sort of the ESG topics, right? That's something that I would personally find interesting. Whether, you know, the editors would want to see that in the same survey, I don't know. But yeah, you know, if I sort of had my own, well, I would probably include that as well. Yeah, I think that's sort of the top two that come to mind that where I would like push further.
Great, thank you.
Thank you. So, and thank you, Ulrich, for butchering your name. I think I screwed up the first name and last name. I just combined them into one sound. This is not really a name. So apologies for that. So I also sneaked in a question, and this question relates, not very surprisingly so, to the link between theory and empirics. So whenever I try to design, let's say, a study from an empirical perspective, but I want to test a certain theoretical prediction, I struggle to get, let's say, a baseline expectation correct that actually fits the cross-section of the data that I'm seeing. So meaning, when I look at the cross-section of firms, I see many small firms that are, you know, have large growth rates, and then I see very few but very influential large firms, and, you know, the distributions are complicated. And then this is hard to calibrate to the, let's say, theory setting where you have more or less homogeneous prototypic firms. So now my question to you would be related, is there a theory model or theory type of models that you would maybe advise us empiricists to look into that give rise to distributional properties similar to what we see in the data? So for example, so dynamic investment models or something, is that something that we should be looking into, something else?
Not that I can really think of. So maybe this is not the answer you were looking for, but let me sort of like take a two-pronged approach to that one. So the first one is like, you know, I think, you know, thinking about what is the distribution of firms in the economy is an interesting question, you know, beyond like trying to have it as an input to like the studies that you want, you know, but like at some point, like I talked to Dave Locker about it, but it's probably also now 12 plus years ago or something like that, and we haven't done it. So whether we should have sort of, you know, one of these biological models where like, you know, people eat each other essentially, and firms would then eventually over time like develop a balance sheet, and they would, you know, compete in multiple rounds, and some would go out of business and some would like stay and grow and acquire others, and see, you know, what is the distribution of firms that we could like get, and then calibrate that to like the actual data, right? And see like what are sort of certain parameters to like, you know, match what we actually see in reality. So that is a question that I don't think, you know, a research project that I don't think has been done. You know, if you want to do that, let me know. Maybe we should like think about that. So that is sort of like on the one end, but it's not like just as an input, I think, then into like your project. I think on the other end, it's sort of a question of like, I mean, in some sense, identification, right? Like similar to many other, you know, empirical studies. And the question then is like, you know, whatever effect you're really trying to calibrate or to measure, right? Can you somehow like isolate that from everything else, right? It's a bit like, you know, when you think in marketing and they want to figure out what is the response rate to like price changes or something like that, right? then they do like this experiment of like changing prices sort of randomly across stores, right? And then with that modeling, like, the risk aversion or whatever, other things that they're interested in, like the response to like certain promotions. And then basically, because they have this sort of randomized experiment, essentially, that's what they use as identification. Then they just throw in everything in the kitchen sink, essentially, right, to like soak up, all other variation. And I think that's when like where structural models would also like benefit a lot, right? It's like if the identification strategy isn't reliant just on the theory, but really combines it with like some sort of like shock of sorts, right? So that was probably more the direction I would go rather than trying to model the whole cross section. But I can see, where the problem is, and if you don't have enough data to calibrate the model like on individual firm basis, or at least like, cut by size, cut by industry, and like do it sort of like, one by one, that's difficult. I think though this last strategy of like cutting and then estimating it like within smaller sets is something that is fairly promising for firms, because we often do have very large data sets, right? And then we can get sort of a distribution, right, of estimates. And that helps us also like in estimating standard errors and that kind of stuff, right? So I think there's a value of doing that as well.
Yeah, I see your point, and I think
I not answer. So.
but I obviously I like them a lot. I like the heterogeneous agent modeling kind of idea, if I get this right. So the first idea, I also think that the idea to do time series, within firm time series analysis is interesting. So one of the problems that we are running into there, I think, is that the number of observations that we need are, again, so long that firms have their structural breaks within their careers. So think about, firms 20 years ago. But I think that all this is really exciting. And I'm also, I have to say, I'm also a fan of the Beyer and Windisch approach. I'm not sure whether you have an opinion on that one, but I personally, I like it as a baseline of thinking about dynamic investment, and then thinking about, given that firms invest dynamically, how would then certain accounting behaviors actually factor into that? Mm-hmm. Interesting stuff. Good. Now we are. So I should have labeled my own question a meta question already, because I think it is already a little bit meta. But now we also have 2 meta questions coming up. And Bianca, I'm really sorry because I didn't manage to call on you ahead. So I hope that you're still around, and Bianca Minov, and that you are interested in asking your 2 questions.
Yes. Yeah. Thank you so much. Yeah, it's actually, the first question is a little bit related to what we have discussed already, like the influence of, or the increasing use of social media as a disclosure channel, and the use of data processing technologies. So there are some changes. And when we now consider your paper like this, the Financial Reporting Environment Review of Recent Literature, this is when we have this on a accounting research perspective, a quite young paper, but now considering the changes, like what are the topics you want to see more research on, or where do you see future research topics in financial reporting environment topics?
Yeah, I mean, like, so first, I think there's a lot of interesting stuff that one can ask, around the social media. As you mentioned, the access to information has changed dramatically, if you think about it, like over, the last 30 years or something like that. And if you think about like, how long it takes to do research and the time series, that Joachim just mentioned, there is like, there's certainly like reason to revisit also some of the, the older papers and the older results. In terms of like, where would be like, where would I go for like empirical research projects right now? I mean, if I had a good idea, I would definitely go after the accounting standards topic, because it really bugs me personally that, we are accounting researchers. And the one thing that makes accounting like so different from all other fields is like how much regulation we have, right? And still, there's so little that we as researchers can say, right, about, what makes good accounting standards. And if we can say optimal, because, as we've discussed, that is a very, very, hard target to achieve, at least let's compare two, let's compare two standards and try to figure out, what is different between the two, what are the real effects, from changing from one to the other, right? Accounting standards evolve, and they evolve quite quickly. So, there's lots of ways where you can, examples that you can go after. Stefan Huber, who's a PhD student here, just graduating. So he worked for his thesis on the new loan loss provision standards for banks. In the US, I'm actually not sure what it is like in the international financial reporting standards, but so there's this shift from the realized to sort of the expected loss model, and it has quite significant implications for the amount of loan loss allowances that banks have. And then the question is how does it affect their lending behavior? And I think these are questions that are really, really interesting, and I think really, really important. I mean, he hadn't even basically put his first draft together. The FASB already reached out to him, because they really want to know, right? And there's so little. And there are empirical studies that look at that, but they suffer from sort of the identification problems that we have, right? When everybody's sort of exposed to the same shock at the same time, there's so many other confounding events. So it's really difficult to figure that out by itself, and I think that's where theory can help to put a structure around that. And when he did a structural estimation then based on that, and I think that's something that is really interesting, I think, and also really, really important. I mean, yeah. That's probably where my heart would be, in terms of other projects or areas where I think there's lots of potential. I think, as you said, sort of the social media space or just, online disclosures, there is potential because it hasn't been around for all that long. It's fast changing. And so, there's just more new data essentially, right? And, stuff that you can look at. But just because it's new, I'm not sure, that by itself doesn't make it interesting, right? You want to have sort of a big level question that you're really interested in, where this is then a good setting to analyze, right? So I think, information processing costs would be one where probably, that is an interesting idea in that context, because it's just so different from you get your mail order accounting report, right? Or annual report. So yeah, if you want to read, and my survey is really outdated by now, but if you want to read a survey in that space, I would really encourage you to read Beth's survey. So that is Beth together with two of my other colleagues or former colleagues like Ivan Marinovic and Ed Dehan. They have this survey at the JE. I was saying it's last year, but it's probably not. It was pre-pandemic, so it was 2 years ago at the JE conference. So yeah. And Ivan is also a theorist, so he really tried to put some structure around that, think about what is sort of the different kinds of costs, the different kinds of frictions, and Ed and Beth both have worked in this space, so that might be something interesting to look at for you.
I have a short, Bianca, do you have another question,
I
right?
was unmuted, sorry. Yeah, so thank you so much for the answer. And the second question is more related to theory, because in another paper you mentioned the role of theory, and also that there's kind of a lack of well-defined constructs and assumptions. So maybe this is more, especially for younger research, interesting, but how can researchers in general improve the building and developing and challenging of theories in accounting, finance, and economics?
So as a theorist, how could you do your research? Is that sort of or how can you come up with research topics? Is that sort of the idea, or?
It's more related to how can we build theory, or how can we improve the theory or the constructs related in accounting and economics? Because this seems to be an issue, and I'm always wondering whether whether you have an idea how to improve it, or how can we challenge assumptions which are already existing in accounting and finance.
So I think, if you wanted to say, and I hope I understood your question correctly, like what are some of the big ways that we could push theory, and like where like, probably like the assumptions that are currently made are like, not particularly satisfying, right? The first one I think is like the time dimension, right? I mean, reputation really matters, I think, in financial markets, and when it comes to disclosure, and and I don't think there's a lot of research, in sort of like these dynamic models where you learn over time, where you learn about people's unobservable characteristics over time, right? And so thinking about that, right, is, I think, really, really important. And I think you also see that sometimes when you read like empirical research on that area, where, one argument then for certain kinds of disclosure behaviors is that, people build reputation, right? But, people build reputation, at least, in rational models, because eventually they want to essentially live off that reputation, right? They want to harvest that reputation. So if you now look at a really large data set, right, and, you basically explain some results, how do I know that the building reputation is actually the one that's like, influencing, these observations versus like, the sort of, if you want, harvesting, in a reputation argument where, many things would predict them exactly the other way around, right? And so I think that is like an area where both, I think, theory and to the extent that I also know, like, in the empirical world, like lots of the literature falls short. And so if we could understand that better, I think that would be, really a construct that, we would be interesting to know more about, and I think would provide important insights. What are other dimensions? I mean, like in some sense, a lot goes back to what, we said in the beginning, right? It's like, models, and as a result, I think, sort of the thought models that we also have in empirical research, right? Very much sort of like one setting, two players kind of models, right? That we have now had, or like multiple players, but not very many. And I think sort of like being careful about like, to what extent that really reflects what's going on in practice, right? That is like another, key challenge. And then the idea is that you would have to find, right, the one other main, first order effect that you now want to bring in, right? Because you never will be able to bring in everything, because it's just such a complex system, right? And then sort of trying to think about like what is sort of another first order effect that we could bring in here, and then look at sort of the interdependencies, essentially. I think that would be another sort of general area where I think there's a lot to be done, but it's also challenging. So I don't know whether I addressed your question or whether that's what you had in mind.
Yeah, thank you so much.
Well, this concludes a very good session, I have to say. So thank you all for being around, but of course, especially thank you to Anne Beyer for giving us not only a brilliant talk, but also very much food for thought in answering all questions. I think that was really, really insightful. And so now we have, besides to thank Anne, we can have a very quick view on what's coming on next. So here I have the slide. So I hope that you can see it in a sec. So this is what's coming up next. So we have now we're moving over to a set of, let's say, more empirical speakers. The first will be David Wieman from Amsterdam. So he will be talking about transparency and market efficiency. So this very nicely, I think, blends to the paper that Anne talked about today. So we are moving over to capital markets. Then Beth Blankenspoor will be around, and she will be answering all the questions through social media that you guys might have. And then we're moving on to somewhat more specific topics, talking about taxation and transparency, and about non-financial reporting with Martin Jacob and Gio Michelon. So I think it will pay off to stick around. Thank you all again for joining us today and for participating. Thank you, Anne. It was a pleasure to have you, and see you all again soon, I'd say. And I'm going to stop recording now, by the way.
Okay. Thank you, Joachim, for having me. That was a lot of fun.
Yeah, perfect. Cheers.